Hello, and you're welcome back to Global Business Insights after a short media break. As always, we look deeper at headlines from a business perspective. A lot happened in the first fortnight of the second half of the year. The mood in the geopolitics went from red to bloody red as the concern for Biden's fitness is overshadowed by an attempted assassination of former President Trump, who on Monday picked populist protege and former critic J.D. Vance as his vice president. A lot can still change in the closely watched race. Trump media and technology company DJT shares skyrocketed on Monday before giving up some gains as traders reacted to the attack on Trump and news that the criminal classified documents case against the former president has been dismissed. Cryptos also inched up on the Trump trade. Trump is seen to favor crypto, and Trump also said he's for competition and supports TikTok as a potential ban looms if ByteDance fails to divest its US assets. A lot can still change in that space. UK inflation held steady at the Bank of England's target of 2% in June, with cost of living at the lowest level in nearly 3 years. Services inflation, which tracks categories such as hospitality, culture, and housing, was unchanged at 5.7% in June, which was higher than economists' estimates. HSBC yesterday announced it has appointed Georgia El-Hederi as Group CEO, replacing Noel Quinn, and starting September the 2nd. Souring relationships between China and the West, tepid growth, and falling interest rates are issues that could be on the front burner for him. Keir Starmer, now settling in as the UK's Prime Minister after a landslide victory, will communicate his agenda through King Charles when we hear the King's speech, which lays out Starmer's priorities. Keir is seen as a pragmatic centrist with leanings to the left. Rachel Reeves, former Bank of England official, as his Chancellor, implies orthodox policies, even as UK inflation stabilizes and the economy struggles to grow. The IMF also slightly upgraded UK economic growth outlook. The Bank of England is seen as making 2 quarter-point rate cuts this year. And in France, the lead swung from right to left as parliamentary elections progressed. Still a lot of uncertainty as Macron yesterday accepted the resignation of his prime minister and entire government. US market so far in the second half of the year seeing a broadening rally. Stocks continue to surge after retail sales data showed Americans are still shopping. The Dow advanced to new highs yesterday as the bull market broadened out beyond technology names and hopes of forthcoming interest rate cuts. Earlier this week, China's economy slowed by more than expected in the second quarter, pulling year-to-date growth down to 4.7%. GDP growth fell sharply to 0.7% quarter-on-quarter in Q2 from 1.5% in Q1. However, industrial production was up 5.3%, slightly higher than expected. In Africa, the pain of reform remains palpable as Kenya braced for more anti-government protests as talks proposed by President William Ruto to help end the nation's quick political crisis appeared to stall. In Nigeria, inflation just out on Monday remains sticky and apparently not peaking as the central bank had expected. Meanwhile, Dangote refinery pushes the date for PMS production to August. The IMF is calling it a global economy in a sticky spot. We will touch on the latest update. Yesterday, in its latest July IMF economic update, we see just tepid economic growth almost everywhere, meaning capped oil prices, more geopolitical upheaval, and the increased need for every economy to be proactive in protecting citizens from fallout of economic weaknesses on the vulnerable. In its updated report themed Global economy in a sticky spot. We see services inflation holding up progress on this inflation and complicating monetary policy normalization. Three issues are striking in the report. The issues all weigh on future growth. First, further challenges to disinflation could force central banks to keep borrowing costs higher for even longer than we presently expect. Higher rates for longer puts overall growth at risk, with increased upward pressure on the dollar and harmful spillovers to emerging and developing economies. Second, it says fiscal challenges need to be tackled more directly. The deterioration in public finances has left many countries still more vulnerable than foreseen before the pandemic. More are also getting trapped in debt as it calls for rebuilding fiscal buffers. Third, there is a new trend of unilateralism in trade countries as everyone seems to be going their own way, imposing unilateral tariffs and measures whose compliance with World Trade Organization rules are, of course, questionable at best. Also, the IMF launched its AI Preparedness Index, showing rankings across 174 countries based on indicators such as digital infrastructure, human capital and labor market policies, innovation and economic integration and regulation and ethics. Singapore, Denmark and the United States lead the index globally, with Singapore number one with a strong 0.8 points, while in Africa, South Africa scored 0.5, Kenya 0.45, Ghana 0.43, Namibia 0.42, Botswana 0.41. Nigeria is ranked below average, scoring 0.34. Bank of America yesterday reported Q2 profits down 6.8% from a year ago as high interest rates weighed on profits. The stock still rose as earnings beat forecasts. Q2 net income of $6.9 billion beat estimates of $6.4 billion. Earnings of 83 cents per share also beat forecast of 80 cents. Morgan Stanley, with its Wall Street business model, also posted earnings of $1.82 a share, better than 1.65 expected. Revenue at $15 billion also exceeded the $14.3 billion estimate. High stock market valuations continue to boost wealth management fees. And earlier, Goldman Sachs had reported Q2 profits soaring 150% from a year ago as investment banking surged. Wall Street is seeing deals coming back as net income was $3.04 billion, beating expectations. Total revenues were up 17%, but investment banking fees, however, did dip 17% when compared to the first quarter of the year. JP Morgan Chase, Wells Fargo and Citigroup also posted sizable jumps in the revenue stream compared with the second quarter of last year. The bank's results seem to support the angle pushed by Sean O'Brien, the president of the Teamsters Union, representing 1.3 million workers, at his speech on Monday at the Republican National Convention, where he railed on corporate greed and demanded long-term investment in the American worker, who are getting the short end of the stick as corporate valuations and profits balloon. Workers, he said, see diminished wallets, hit by high cost of living, while corporate giants smile to the bank. And on Monday, Federal Reserve Chair Jerome Powell gave an interview, his first public appearance since the CPI print last week. Annual inflation rate in the US fell for a third straight month to 3% in June, the lowest since June 2023, compared to May's 3.3% and under 3.1% expected. Gold went up after the chairman of the Fed. Gold went up after the chairman of the Fed, Jerome Powell, said good progress was being made on curbing inflation. Market-based probabilities are now showing a 100% chance of the Fed cutting rates at the September meeting. Before the recent remarks, the probabilities was just above the 60% mark. The head of the Fed also reaffirmed that the Fed won't be waiting until inflation reaches the 2% annual target, adding that the US economy performed remarkably well in the last couple of years, but this year the economy is expected to slow. Also, the labor market is no tighter than before the pandemic. He also said Q2 inflation does represent progress with 3 better recent readings, adding confidence in inflation falling is now being seen. But he's not sending any signals on any particular meeting, though more good data is adding to confidence. And in Nigeria, according to the National Bureau of Statistics, inflation inched up to 34.19% in June from 33.95% in May 2024 for the 18th consecutive month, driven by high food inflation. Month-on-month headline inflation also grew by 0.17% to 2.31% in June 2024 from 2.14% in May. This was also the first increase in month-on-month inflation after a recent trend of declining month-on-month price increases. According to Stanbic IBTC, S&P Nigeria PMI sank to a 7-month low of 50.1 in June, further down from 52.1 in May. However, purchasing activity and inventories increased on efforts to get ahead of expected future price rises. But on the price front, elevated prices in June linked to currency weakness and higher raw material costs, particularly those related to animal feed, led to companies raising their selling prices sharply again in June. Business confidence was also said in the report to be close to the lowest on record. On inflation, all eyes will be on the Monetary Policy Committee, which has raised interest rates by 14.75 percentage points since May 2022 to 26.25% and may still hike rates again at its next meeting on July the 23rd. The Apex Bank had signaled that inflation will ease around April, May, and so will be concerned with the latest sticky prints. Still, the impact of the scaling back of gasoline subsidies a year ago and currency devaluation on inflation should start to recede, and measures such as importation of food to improve supply and suspension of import duties on certain food staples should reduce costs. Also, it was reported that farmers in the nation's central region are seeing better harvests of Irish and sweet potatoes, which is resulting in prices crashing. Higher inflation weighs on growth and worsens poverty. The urge to raise rates by the Monetary Policy Committee should be tempered by concerns that the economy is already being crippled by high cost of borrowing, and more needs to be done on supply side reforms such as the bottlenecking supply chains, reducing costs of doing business. The MPC needs to factor in the lags between rate action and impact on prices, which also can confuse the dynamics. Some good news, however: capital importation in Q1 2024 saw a huge spike from $1.088 billion in the previous quarter to $3.376 billion. However, foreign direct investment, which has a more direct correlation to stable economic growth and jobs, fell from $183 billion in Q4 last year to $120 million in Q1 2024. Higher portfolio flows are a sign of an improved investment climate, and as confidence continues to improve, FDI growth is expected to follow. Analysts are still urging for more structural reforms, warning that half-cooked reform and tactical measures will not be enough. Managing the pain requires more proactive planning. The government is expecting a J-curve recovery trajectory as it pushes reform, but it has to be sensitive to managing what looks like a lingering downtrend, focusing on how to ameliorate pains in view of the acute absence of familiar safety nets available in other countries. I would advise slashing down cost of governance of the current government by at least 30%, holding on interest rate hikes and waiting for the impact of supply side reform while bringing down business taxes and pushing new structural reform to help economic growth. And to close, Asian stocks mixed today as semiconductor groups sold off due to geopolitical concerns. Well, that's it from me on Global Business Insights. This is Brody Oshosami. Bye-bye.